property investments across Asia Pacific jumped by 15.7% in the third quarter with a lot of cross-border action. To get a sense of how local markets are comparing, we have Christine Lee from Knight Frank to give us the Asia Pacific perspective, Kathy Lee from Colliers on Hong Kong, and Alan Chong from Savills focusing on Singapore. Christine, starting with you, what trends stood out across Asia Pacific in Q3?
I think in the Asia Pacific region, we are seeing cross-border investment volume rebounding quite strongly, especially from Q3 onwards. And this is also driven by the data center deal by AirTrunk. So that transaction volume amounted to US 16 billion, and that's one of the largest on record. Although this is an exceptional deal, even if we take out that data center deal, we are also seeing data center space growing by 36% year on year comparing to last year. I think this is mainly driven by the AI boom. In the traditional real estate space, we're also seeing office taking a lead in terms of the transaction volume, particularly in Singapore, Seoul, as well as Sydney. So the office volume has gone up by about 17% year on year, and we are also seeing interest in the logistics space.
Yeah, for Hong Kong, we're actually seeing like a growing interest in the distressed and capital loss assets. So which is we saw that the deals are involving a distress or capital loss assets increase from 7% in Q1 to nearly 50% in Q3. So we see investor and also end users are positioned for quality assets at deep discount. Actually, some of them actually transacted at 60% decline from their purchase price. And we also see the capital value continue facing pressures when we still are in a relatively high interest rate environment, and actually buyers actually got the upper hands. So we expect that the rate cuts with the cap rates will continue expanding. So it seems the negative carry will level down, and then the money going back to value play. So we have a less overpriced and then maybe undervalued market. And we think that Hong Kong is now quite well positioned in the coming quarters and coming months.
Well, in Singapore, I think we saw transaction values in the third quarter rise 32.6% quarter on quarter to 14 billion, just slightly over 14 billion Sing dollars, or about $10.2 billion US. So it's been driven by commercial deals and an industrial deal. One is the 50% stake sale of ION along Orchard Road. It's a high-end shopping mall. And the other is a portfolio of industrial properties by Soybuild that went for 1.6 billion Sing.
Now let's talk about its effects. What regional or global impact do you expect from your third quarter data? Let's start again within Asia Pacific.
Yeah, so in the last 2 years, I think due to the elevated interest rate environment, institutional investors really took a back seat to wait for price discovery, and the market also experienced this liquidity crunch, with some investors having to take a haircut to divest some assets, like what Katie mentioned, which is not good for the overall stability of the real estate market. As a lot of people know that the real estate market itself is also tied to the real economy, as the real estate ecosystem also include your funding, financing, as well as construction, which are also crucial part of the economy. So going forward, as the interest rate environment stabilizes, especially with the recent cuts, we think that the bid-ask spread are expected to narrow, and that will help to bridge the valuation gap seen in the commercial real estate market. And also this increased the liquidity will help to connect demand and supply in the market and allocate investment, and also allow developers and investors to access capital needed for new projects.
Yeah, we are facing a quite similar interest rate environments compared to some of the APAC markets. So actually for the high interest rate environments, the most of the investors are having like a problems like getting their finance or like relatively facing high like capital costs, and also because of geopolitical reasons, some of the like European or American institutional investor has been avoiding investing in China, including Hong Kong. That have affected like the investment interest in the Hong Kong market. But like similar to as Christine has mentioned, like the recent interest rate cut, which will help to like boost the investment sentiment and help to lowering like the capital cost, the cost of capital, and we expect like the investment sentiment to be improved like in coming months. And also as Hong Kong's like most of the assets already like quite a good value, undervalue assets, and some of the other APAC markets may seem a little bit overpriced. So we expect like the assets in Hong Kong will attract a lot more interest like in the coming quarters.
Well, I think in the past, Singapore and Hong Kong seems to be sinking together, but I think with the geopolitical problems, the two markets seem to be separating. Singapore has been driven mainly by the sale of trophy assets and industrial properties. Now, for trophy assets, some buyers may be willing to take that leap forward, even though interest rates are pretty high. Now, but that doesn't mean that office buildings will be that easily transacted, because the yield from office assets are pretty low. The cap rate is about 3.5%. The all-in borrowing cost could be about 5%, and so that's a big spread. But for retail, if you are looking at say 5% yield, high 4 to 5, and if the asset is good, there could still be transactions, as we saw in the case of the Ion Mall transaction. And for industrial, yields are generally higher than the all-in borrowing cost, and therefore we see transactions. So I think it's who is closer to the break-even in terms of matching interest rates. That sort of assets with that sort of yields will see transactions.
Now, considering where we are currently at, what's your outlook for the fourth quarter and beyond? What key market indicators will you be monitoring, starting with Asia Pacific again?
So for Q4, we do expect cross-border investment in APAC to add another 9 to 10 billion USD. And with this momentum, I think the region is expected to see about a 50% increase in terms of the investment volume by end of 2024. And also going to 2025, I think the investment volume is expected to stay buoyant, and particularly from markets such as Japan, Australia, as well as Singapore, due to the favorable economic tailwinds that we are seeing in the market, and particularly with Fed easing rates further, I think there will be a boost in terms of the volume going ahead.
Yeah, I think for Hong Kong in the coming months or quarter, like the distressed like sales will still be the main theme, especially for the office markets, because the high vacancy rate in the Grade A office markets has like drive both the price and rent down, like and we expect that will continue in the coming months, and so that like a further cap rate expansion will be needed. So, but like still there will be rare chance like for prime stock for sales. Mostly you will see like maybe stratified like office sales or some like Grade B building like on block. But like for retail, we think that like the tourist like rebound will actually help like the investment market, particularly like when the interest rates start to come down. So like that will be a relatively like a bright prospect for the retail markets. But like for the industrial markets, because the vacancy also relatively high, so like and actually the demand in the markets is relatively weak. So we think that like that some investor or owners will be facing like a pressure to sell their property with a little bit of like adjustment on the pricing.
For the fourth quarter, I don't think that we will see a repeat of what happened in the third quarter, because in the third quarter, as I mentioned earlier, there were two major assets, commercial assets sales. So in the fourth quarter, it will be probably be dominated by asset sales or purchases by ultra high net worth individuals, and that will probably be dominating the market. But if you have a bonus coming in the form of a collective sales side going through the $810 million sale of Thomson View, if that is successful, then we will probably book that in. So for the full year, we will still stick with our 22 to 23 billion Singapore dollar transactions value for this year. In the third quarter, we have already hit about, year to date. Sorry, in the third quarter, we hit year to date 18.4 billion. So we've still got about 4 to 5 billion to go. I think we may just hit that levels.
Thank you so much for joining us today and for sharing your insights, Kathy, Christina, and Alan. Once again, those were Kathy Lee, Head of Research at Colliers Hong Kong, Christine Lee, Head of Research for Asia Pacific at Knight Frank, and Alan Chong, Executive Director for Research and Consultancy at Saville Singapore. For more news, visit realestateasia.com.